2022 has been a dream year for most of the real estate developers, as they are calling it the start of a multi-year bull cycle when it comes to real estate. So here we are at one of the key projects of Keystone Developers, popularly known as Rustom Ji, recently listed on the bourses on 24th November with a premium of 3% to the issue price. It is a Mumbai-based real estate player with 32 completed projects as on 30th June, 12 ongoing and 21 forthcoming projects. It has strategic investors and partnerships with the likes of HDFC Capital, Affordable Real Estate Fund 3 and Liparton PTE. In the past, it has had investors like Giza and HDFC Real Estate Fund 1 as well. Now let's talk about bookings now. As on 3 months of FY23, 244 crore rupees is the amount. FY28, 1,000 crore rupees. Bookings are now 2640 crore rupees, so that is the normalized run rate. Volumes 1.48 million square feet, that is in FY22, and in pandemic it was between 0.9 to 0.7 million square feet. Debt was the big issue for the company, but now they have been able to reduce it substantially. From 7.7 times, that's the debt to equity ratio, they have reduced it to 1.1 times. Company says they want to maintain a 1:1 debt to equity ratio, and they do not have any plans to step outside of the Mumbai market, where they have 9.5 million square feet of ongoing development. They also have a strong launch pipeline, and they have enough launches in the pipeline for next 8 to 9 years. They also are focusing a lot on redevelopment, which is right now 11% of their total portfolio. A quick look at valuations in real estate. It is based on sales to market cap. Keystone is reasonable at 3 times, in line with Brigade and Prestige. Mumbai-based players like Godrej and Oberoi have it higher, between 9.8 to 17 times. DLF2 is higher at 16.6 times. Now that we have a brief about the company, let's go ahead and take a deep dive with the chairman and managing director. Promised, we have with us Mr. Boman Irani, who is the Chairman and Managing Director at Keystone Realtors. Mr. Irani, thank you so much for joining us here on Inside Out. It's a pleasure to speak with you, and especially when real estate sector is all everyone can talk about, especially in 2022, right? So that's what I wanted to ask you first up. What's causing this sudden spurge in demand that we're seeing in the real estate sector? And do you expect it to continue? Rising interest rates, that will not be a problem. And how long do you think the cycle will go on for?
Hey Sonal, thanks for having me on the show. First of all, let me tell you, there are lots of reasons why the real estate has actually taken off the way it has. Key being that in India, we're largely building our wealth to actually real estate sources, right? And most of the families have about 60% of their wealth growth coming from real estate itself. We've seen that in the past few years, there's been so many ups and downs that people have decided to move towards a little more stability, and they're looking at long-term safety for their money. And that's where cities like Mumbai and MMR have grown hugely. I mean, look at this development, for instance. It's one of the largest redevelopments in this area, with 168 members getting new homes from their old buildings that they had, and almost about 400 apartments being built for sale, where you almost see a congruence in the kind of redevelopment, whether it's the rehab or it's the sale buildings, as you can look around you. So this has led to a newness or a kind of a youth infusion into the city of Mumbai, redevelopments. Add to that the infrastructure that's being built across the country. This is leading to a lot of commercial development as well. And with every 1 square feet of commercial development, 10 square feet of residential development also takes place in the city. Most of the new developments, in the earlier days, we used to sit with the architects and worry about how to save 6 square feet here and 4 square feet there. Today, even if it means an additional, 12 or 15 or 25 square feet, we still want to create all those requirements that are there for a good home.
So Mumbai will continue to be the focus market. What is it about the Mumbai market that keeps you focused on this one? Lesser or limited area here, higher prices. Of course, higher prices is good for the developers, but will that continue to be the big focus point?
So wait, last statement first. Higher prices do not mean it's great for the developers, right? Most of the developers today are working on, let's say, margins that are almost business-like margins. Gone are the days of yore where you bought a plot of land, it kept on appreciating. As a matter of fact, your inefficiencies helped you. Today, it is all about creating that efficiency. Now, as far as Mumbai and MMR are concerned, I told you about the infrastructure that's been developed. Over 60 years, the kind of infrastructure that was not done in this city has been done in the last 5-6 years. And obviously, this means that the city is growing, it's getting a lot more bigger. Secondly, Mumbai has always been the Sone ki Chidiya, right? Everywhere, from around the country, people have wanted to come over here. It is that desire to come into Mumbai. Of course, Bollywood has helped in a big way to kind of, increase the charm of this city. But the city has a charm. So yes, as far as we are concerned at Rustomji, we are decided that we are one of the prominent developers in this city. I can see a whole host of developers from outside the city come over here. So hey, I am a prominent developer here. Everybody finds this market interesting. Why don't I stay here and keep growing as one of the prominent developers out here, rather than trying to go to other parts of the country? I think Mumbai today is one of the best in terms of developing cities. You and I are suffering because of the traffic due to the excavations everywhere. But think 2 years or 3 years down the line, when to 2025 your metros will be running, your sea link would have been completed between the city and Bandra and going all the way up to Warsaw. We've got a great future out here.
You spoke about redevelopment. You spoke about a place where we are right now, which is a redeveloped property. That has been the big focus point for you as well. What is it as a percentage of your focus or the portfolio right now? And will that be the focus point, or you look at affordable or luxury going forward?
So good question. And so the points that I want to speak to you about is Rustomji is in all classes, or what I classify as all classes of residential real estate development, and we are largely a residential developer. So we've got something called the affordable housing, and affordable, again, one has to be cognizant of the fact that affordable is affordable to various types of classes of people, and various cities have various affordable definitions even by the government. So we are in the under 1 crore, which we categorize as affordable. These would mainly mean Virar, where we are doing a 217-acre township. This would also mean Dombivli, where we've just acquired or entered into a joint development with a landowner, where we're going to about 2.2 million square feet of development. Then we have the mid to mass, which we categorize as the 1 crore to 3 crore. This would mean everything from Thane, where we're doing 127-acre layout, to Borivali, Kandivali, Malad, Goregaon, all that area where we are again focused on continuing to stay in the mid-mass, a large developer in the mid-mass. Then we have what's called the aspirational category, the 3 crores to 7 crores.
But still, redevelopment is a bigger chunk?
Redevelopment, good. I should touch upon this. So Rustomji has been in the business of redevelopment since the year 2002. And at that point of time, a 12-member redevelopment of a tenanted building was done by us. What we realized at that point of time, redevelopment was actually not just a money game, but it was to understand, it was more about how you deal with people. So we built our skills on this front, and we continually trained ourselves to be kind of approachable by the people of the building. So every resident in this building, that's already been redeveloped has my mobile number. He can WhatsApp me if there's any kind of an issue. And within 24 to 48 hours, my team would have kind of taken care of that. So redevelopment today forms about 11% of our portfolio, but we are going to grow this, because now is when redevelopment has really taken off in this city.
So are you tracking sales which are better than pre-COVID? 2,600 crore is the last known number in terms of bookings. Maybe you can't give a forward-looking number here now, but are sales better than what you saw earlier? And are they going on increasing at the rate that we've seen in the industry?
So we just got listed on the 24th. I'm in some sort of a silent period for the next 40 days. So say after the 5th of Jan, if we meet, I'll give you a lot of my views, but till then I've been told to kind of control. But yes, sales during COVID, more than you seeing a higher number, what all we've learned is the consumer is a lot more focused. They are aware of what they are looking for. They've done a lot of research already before they come to the sites itself. So about, I would say 30% of my sales are spot bookings, and they're spot bookings because people come in and write a check. So we call them spot bookings. But when you do dive in a little deeper, you do know that this customer has actually done the entire research of what he wants or what they want as a family, and they're looking for a particular type of development, and they've chosen the location, and that's how they've come over here. Our reach also shows us that basically the buyer has started becoming a little younger as well. So millennials who were not buying pre-COVID have also decided to start putting their money into a home, because finally everybody at some point of time does understand the power of, you know, security. And this has been a big shift. You've seen the kind of high value properties and selling a lot more than they were before. At one point in time, we always said the affordable and mid-mass are the ones where the maximum churn took place. They still are in terms of numbers, but in terms of value, the premium properties have really done extremely well.
Yes, that's something we're seeing in numbers across listed developers. One question that I think as a viewer, as an investor, and as a person who's living in the city of Mumbai, why are the prices so high?
So I already mentioned to you that prices, according to us, should be lower than what it is, because they could mean that there's a lot of buying that takes place. But if you look at land prices, we're a landlocked city. Land prices itself, if you look at the kind of premiums that are payable, add to that you know, GST in the way that we are you know, facing it right now, we are paying 18% GST on all our construction material. At the same point of time, you as a buyer are paying 5% on top of that, and the developer does not get an input tax credit. When you add all these small parts, and then of course the cost of living being high in Mumbai, you know, the added features where we've got to provide for you know, a proper lifestyle in the city of Mumbai. The cost of people itself is higher in the city of Mumbai, so there are more and more compliances that real estate developers have to undertake. So all this keeps adding up to the cost. I would not say costs are high. They are high compared to some other cities of the country.
Okay, interesting. So the one big talking point has been how you have been able to reduce your debt considerably over the last couple of years, right? And that is one of the things that investors liked as well. What is the debt equity ratio you're comfortable with?
So first of all, let's go through the cycle of a developer's life, right? He first starts off with private capital, debt, then goes into PE, you know, goes into other kinds of funding, and then finally comes to the doors of the capital markets. And then, you know, once he's ready as a company to be able to be compliant, transparent, and, you know, someone that is open to all observations of the people, he comes to the capital markets. We did not need to come to the capital markets because of the fact that the debt was high. Our debt wasn't very high. As a matter of fact, in 2018, we started reducing. We started on this path of reducing our debt, and we brought it down to absolutely manageable levels, where all the debt lay in the projects itself, ongoing projects. But we've decided to bring that down as well right now, so that there's headroom for growth again. A 1:1 debt to equity is something that real estate developers can happily, you know, survive or take care of and be a healthy company.
Yes, that's true. So you've spoken about the debt, comfortable debt number, the fact that your sales are tracking pre-COVID levels or even better than that. What is the launch pipeline looking like? You have a lot of inventory in place or pipeline in place which will commercialize in, say, next 2 to 3 years?
So I'll tell you the philosophy. We are one of those companies that constantly replenishes you know, in the same areas where we have completed projects. This project is nearly complete. The last building will get completed by March, April, or by March this year, 23. We've immediately tied up with 2 more developments in this area, which would be ready for launch in, let's say, the next 6 to 8 months. Likewise, in all our other projects, except in Thane and in Virar, where the land holdings are extremely large, 217 acres in Virar, 127 acres in Thane. There I don't see the need to go ahead and acquire many more. Having said that, we are looking at, because a particular kind of development that is possible, a new market that's opening up, is opening up in Thane as well. So we might acquire some more development rights out there. But today, we're with our philosophy of affordable, mid-mass, aspirational. We've just acquired or just done signed a joint development for a property in Mahim. So yes, we keep replenishing our stock, and we do it at about 1:1.5 ratio. For every 100,000 square feet that we complete, we're acquiring about 150,000 square feet. The idea being that this is in the pipeline and it takes some time to come in. The average timeline between acquisition and start, and I'm not speaking about all projects, would be anywhere between 6 months to a year. So one has to kind of plan that in advance.
So we are here at the basketball court. You know how to play basketball?
Well, this is a multi-purpose court actually. So basketball, tennis, I guess kids play all kind of throw ball and stuff out here. And yeah, I can shoot a few hoops, for sure I can.
So we'll do that off air for sure. So when you're talking about strategic partner in the commercial space, you have seen partnerships or at least equity investments from say HDFC Real Estate Fund. Is that continuing now?
Through the life of Rustomji's story and growth, we've been partnership driven. So everything from, first start off with us three, right? We're three partners, and in the true sense of the word, 26 years together, touch wood, we've been partners. And we've built our entire business on joint ventures, joint developments. We've worked with landowners, we've worked with other developers. Our project today in Bhandup, which is Bella, which has done extremely well, is again a developer who's tied up with us, and we're working with him together on that. Our development in Virar is the same. Our development in Thane is a joint venture. So we do joint ventures and joint developments. All our society redevelopments are all in a way joint ventures with the existing members of the society itself. So a partnership is a mindset that is very, very true to Rustomji. And we believe that, there's always a win-win situation that can be created for every kind of partnership, and we really work towards that.
Thank you so much, Mr. Irani, for joining us here on CNBC-TV18, explaining all about Rustomji and what are the plans going ahead as well. But of course, we'll speak soon.
I look forward to being on your show again, but thank you for having me here.
Thank you. With that, it's back to you in the studio.
All right, that was a deep dive in Keystone Realtors. With time to slip into a short break, we'll come back with another interesting stock. Power Finance Corporation is the stock on our Swotlight segment. Welcome back. You're tuned in to Inside Out on CNBC-TV18, where it appears there's a bit of a re-rating underway on PFC. And so the stock features today under our Swotlight segment. The stock has rallied 40% the last couple of months, and even post the rally, valuations appear reasonably as at around half times price to book. Now, part of the reason of cheap valuations could be that it's a government-owned entity. The company is a specialized financial institution in the power sector. PFC funds Gencos for capex and discoms for working capital needs. The central government schemes like Uday, they tasted limited success, but reforms implemented in the power sector have started taking shape and are giving a makeover to the sector. Hence, REC and PFC, they are well placed, but as we know, REC is owned by PFC. The Ministry of Power, state governments as well as distribution companies, they have implemented various reforms, and as a result, the viability of the power system has improved. This was necessary because demand for power has been growing, and further investments will be necessary for the power sector to expand to meet the growing demand. And the investments will only come if the power sector remains viable. The Ministry of Power has said there's a marked reduction in the aggregate technical and commercial losses of DISCOM in FY22. In fact, the AT&C losses of DISCOMs, they have declined significantly to 17% in FY22, which compares with around 22%. In September 2021, the Ministry of Power revised the prudential norms of PFC and REC, which stated that DISCOMs cannot avail financing from PFC or REC unless they draw up an action plan for reducing losses within a specific time frame and get their state government's commitment to it. The revamped distribution sector scheme lays down that funding under the scheme will only be available if the DISCOM commits to an agreed loss reduction trajectory. The 15th Finance Commission provided for an additional borrowing window to states contingent on them taking steps to reduce their DISCOM losses. Further, in June 2022, the Ministry of Power issued a late payment surcharge rule, which provided that unless the distribution companies promptly pay for their power drawn from the interstate transmission system, their access to the power exchange will be cut off. Well, while putting all these in place, the Ministry of Power also worked with the distribution companies to provide the necessary finances under the RDSS for undertaking the loss reduction measures. Implementation of the Electricity Rules 2022 has not only ensured that the outstanding dues are liquidated, but it's also ensured that the current dues are paid in time. The impact of these measures is visible as the total outstanding dues of states has reduced by around 25,000 crores to around 1,13,000 crores, thereby bearing witness that the implementation of LPS has reflected notable improvement with regard to recovery of outstanding dues of suppliers, including GenCos, transmission companies, and traders as well. Well, as of September 2022, the gross loan assets are at around 3,77,000 crores, and they have disbursed close to around 22,000 crores in the first half of the fiscal. The breakup of the loan book, well, that's up for you on the screen, with generation as well as distribution companies forming more than 90% of the book, and majority of the lending being done to government entities. Well, its gross NPAs has reduced to sub 5%, and the net NPAs has come in at its lowest we've seen in 6 years. Now, moving to the valuation front, well, the stock trades at around half price to book. That's post adjusting the REC stake, which gives some kind of comfort on the valuation front, even post the recent run-up in the stock. This is further backed up by solid dividend payout, which has ranged between 9 to around 12 rupees over the last few years. Now, with an eye on FY24, the street is hoping for loan growth of approximately 8%, driven by infrastructure financing opportunity, a pickup in the capex cycle, and greater credit demand by generation segment on heightened power demand versus supply. Margins could also bottom out even in a rising interest rate scenario as asset repricing happens every 3 years. Additionally, expect lower credit costs because of significant provision buffer in place, and also lower slippages because of stress already recognized in the private sector. Well, since it's a government-owned entity, there's always an overhang with regard to capital allocation, delay in growth revival, as well as resolutions, and also higher haircuts in the projects under resolution. One more risk is the free power schemes by some states. Well, that could affect the financial viability of some of these discoms. Well, that was about PFC, but we have run out of time on this edition of Inside Out. It's goodbye from Sonal and myself. But you keep writing to us and tell us what companies you want us to discuss and you want to hear about. We'll try to feature them on our show. Thanks so much for watching.